Okay, hello everyone, and thank you for joining us for today's National Conference of State Legislatures webinar, which is a budget and tax update. My name is Mandy Rafel, and I'm the director of the NCSL Fiscal Affairs Program. And in case you are just tuning in to an NCSL event for the first time, this slide gives a short overview of what we do. NCSL is a bipartisan organization that serves the legislators and legislative staffs of the nation's 50 states, its commonwealths, and territories. NCSL provides research, testimony, and opportunities for lawmakers to exchange ideas on pressing state policy issues. Today's webinar is the fourth event in NCSL's five-part fall fiscal webinar series, Budgets, Taxes, and Pensions, Oh My. The final webinar on emerging state tax issues will be held next Thursday, November 19th, at the same time as today's. For more information on NCSL's meetings, activities, and services to legislators and legislative staff, please visit our website at ncsl.org. So before I introduce our speakers, I want to review a few housekeeping items. Today's webinar is a platform for information exchange and engagement, so we encourage participation through our chat box, which you'll see on your lower left side of your screen. So feel free to get some practice and type your state and introduce yourself on the chat function, just so we know who's on the webinar today. And this is also where you will type any questions and respond to any questions in the chat box. And then the final housekeeping item is that this webinar is being recorded, and there will be a video recording of the event made available on our website in the next few days. So getting back to the task at hand in the webinar on budget and tax update, it's my pleasure to introduce three of my NCSL colleagues. First, we'll hear from Erlinda Doherty in our Washington, D.C. office. She's going to give us a quick update on federal stimulus talks and any other federal budget news. Then we'll hear from Erica McKellar and Jackson Brainerd from the NCSL Fiscal Affairs Program. Erica covers state budget issues, and Jackson follows tax issues. And then after all the presentations, we'll take questions from the audience. Again, type any questions or comments in the chat box. And so at this point, I will go ahead and turn it over to Erlinda.
Great. Thank you, Mandy. Hope you're doing well. And thank you, friends and members and legislators and staff, for joining us today. It's always an honor and a pleasure to be able to communicate with you all and engage with you, especially during these turbulent times. So thank you for that. But yes, as Mandy mentioned, I'm going to give a very, sort of a brief federal post-election update on what's been happening here the last few days going into the lame duck Congress. So here we go. As I mentioned here, we're currently back in a lame duck session here. It started this week on Monday, or officially, I guess, Tuesday. And, as you have all been aware, we've been in the middle of a huge election here, a historic election, where Vice President Joe Biden is currently projected to defeat President Trump, which would make this the first time since 1992 when an incumbent president has lost re-election. But the Senate composition, as we know it, will not be officially decided until January, because we are having a runoff at that point for two senators in the state of Georgia. So that will be something that we're going to be tracking and following here based on those developments. The House Democrats have maintained their control of the majority, but have maintained control, but the majority has eroded as they lost a few seats as well in this race. So basically, we are not going to see much change in the congressional leadership as well. So we expect that the same House and Senate Republicans and Democrats will be in charge. Speaker Pelosi has retained her position, and Majority Leader Mitch McConnell has also retained his status as Senate Majority Leader. So basically, going into this session, President Biden is pretty much going to be inheriting President-elect Biden, that is going to be inheriting a status quo Congress, and will definitely need to navigate a very delicate policy tightrope between Speaker Pelosi and Leader McConnell, with COVID-19 legislation being the immediate opportunity where bipartisan cooperation will be key. So as the next item here, as you can see on the list of things here on the agenda, COVID-19 legislation is the top priority, but the relief package that we've been looking at or dealing with since really the summer is still uncertain. Despite progress during pre-election negotiations, the administration Democrats remain pretty far apart on actually coming to an agreement on what this next package and stimulus package, should be. Both Majority Leader McConnell has stated that Congress should pass another round of relief during the lame duck session, and Speaker Pelosi, of course, remains steadfast on her need on the need there for another robust multi-trillion-dollar stimulus package. And despite reporting progress following a series of pre-election negotiations, the White House and congressional Democrats remain pretty far apart on the scope and size of what this next pandemic relief package should be about. So we'll have to see. It's still very uncertain at this point. There's still about $1 trillion difference between the two, so we'll have to see in the coming days what that's going to be like. Of course, we've been advocating from day one for additional flexible funds for the states to use to help combat the effects of this virus, and we continue to track and monitor it. But now, given President Trump's expected loss, it remains to be seen whether the administration will be willing to negotiate a little bit more and sign a COVID-19 relief package prior to the end of the 116th Congress, or whether this will, be protracted until the 117th Congress is officially sworn in. And again, the big differences that are still remaining that need to be reconciled are state and local aid, liability protections, unemployment insurance, and testing. So your guess is as good as mine at this point. So what's going to be happening with this next stimulus package? Okay, stay tuned. Next is the appropriations outlook. So obviously we need to avert a government shutdown here. Most of the spending packages or the continuing resolution that was passed before the election is due to expire December 11th. So it looks like the passage of what we call minibus, or smaller bundled spending bills, if you will, spending packages, are likely to fund the government through FY 2021. The House passed most of its bills this summer, and the Senate just released a series of their spending bills Tuesday, that is. And the spending agreement, whatever that is, it could end up being the vehicle for some other last-minute policy items and potentially COVID relief. So that remains to be seen. And the House Ways and Means Committee is their agenda with respect to appropriations and appropriations priorities is pretty aligned with what Senator Biden's policy priorities are as well, as you would imagine. But neither party has a mandate. So, going into, so cooperation and negotiation will be key and vital going into the 117th Congress. Okay, so a little bit about President-elect Biden's transition agenda. He has amassed a team of very sort of key federal agency alumni. So a lot of these individuals that he has put forward in his transition team, if you will, have a vast amount of federal agency experience. And of course, the first 100 days of his presidency will set the stage, for what he's going to be doing. We see a lot of, we envision and predict a lot of regulatory items to be happening, not so much legislative, because of the divided Congress that he's going to have to be dealing with. But we do anticipate that he will rescind and freeze several regulations from the Trump administration that he deems to be, not part of his priority plan. So here we, sorry about the slides here. I'm not really sure what happened. Okay, here we go. I'm back on this one here. Sorry, I didn't transition to that. So anyways, and we mentioned here his major policy priorities have been pretty well explained, and those would be comprehensive national strategy to combat the pandemic, of course. He has maintained that investing in infrastructure is key to his agenda, providing a middle-class tax cut, reforming healthcare by expanding the ACA, and tackling climate change. And his proposal for COVID-19 encompasses the areas that you see here on this slide. To include $700 billion in economic recovery plan, additional support for small businesses, testing in schools, a nationwide mask mandate, and to boost the mask stockpile, $25 billion for therapeutics and a vaccine, creating a national contact tracing program, addressing state and local budget shortfalls, and establishing a new U.S. public health job corps. And also of interest to this group would be his tax proposals that he's laid out, and you can see them sort of listed here, but generally speaking, tax credits for new investments in manufacturing domestically, raising the corporate tax rate, providing tax relief to lower middle income families, including expansion of the child tax credit, incentives for retirement plans for employers, taxing capital gains and dividends at ordinary rates for those with annual incomes of more than $1 million, providing refundable low-income renters and first-time homebuyer credits, and so on and so forth. So he definitely has a pretty robust tax agenda as well. But it remains to be seen again what all will happen as we move forward. The big item right now is getting the government funded and preventing a government shutdown. By December 11th, when the current resolution is set to expire, and then this debate upon whether or not COVID-19 relief and stimulus will actually occur. So I hope that was a good overview, and happy to take any questions later on or whenever you're available. And I'll turn it now over to, of course, here's my information here. If you want to reach out to me, I'd be happy to communicate with you that way. All right, so next on the docket is, I believe, Jackson.
Actually,
sorry,
this
Erica.
is Erica.
Oh,
no
sorry
problem,
about that,
Linda.
Erica. Okay.
No, thank you for that great update. Appreciate it. So thanks to Linda and Mandy. I'm Erica McKellar with the Fiscal Affairs Program at NCSL, and I work primarily on state budget process issues and tracking state fiscal conditions. And we've been working on keeping tabs on the state revenue picture, and there's still a lot of uncertainty out there, but I'm going to provide some insight into what we do know and some data and information we're seeing from the states. So I think at this point, we know that the pandemic has affected every state and every state budget. It's been uneven and in different ways, but no state has escaped some of the economic effects that we've seen. At the start of everything, personal income reliant states were affected by the staggering number of unemployed people. They will also face some complications with delayed tax filings that pushed some personal income taxes that they had anticipated in fiscal year 2020 into fiscal year 2021. And I think, they continue to face some challenges with the number of unemployed workers. I think that picture has improved somewhat, but still very, very high numbers of unemployed workers out there. States that rely heavily on the sales tax clearly had faced some challenges at the start of the pandemic when much of the economy was shut down, retail and restaurants were shut down, and people kind of shifted their spending to things like groceries, which are largely tax exempt in the states. We have seen strong online sales tax collections, which I think has helped somewhat, but I think those states still face some challenges as states start to reopen. But, with the virus surging, some states are kind of rolling back some of those openings. So some continuing challenges for those states. We've also kind of been saying since the beginning that a couple categories of states that are the most vulnerable are tourism-reliant states and energy-producing states. And I think that continues to be true. The Pew Charitable Trust anticipates that Florida, Nevada, and Hawaii could face double-digit revenue declines next year if tourism doesn't rebound. And the leisure and hospitality industry has seen the most job losses from the pandemic of any industry. So clearly they're facing some prolonged challenges. Energy-producing states are also still struggling as oil prices remain relatively low. So they've faced some additional challenges in addition to the pandemic, and I think that will continue. So back in July and August, at the start of the new fiscal year, we surveyed legislative fiscal offices to try to get a handle on sort of the magnitude of the revenue shortfalls that states are facing. And I apologize that this is a little difficult to see. It's an interactive Power BI graphic that you can access on our website and kind of shift over all of these to see the exact percentages. But this is a look at what states were projecting for fiscal year 2021 compared to what they had previously projected for fiscal year 2020. So you can see that state general fund revenues were declining in almost every state. And when we did this, not every state had revised their forecast. So there are still a few states that either had revised and are lucky enough to still be seeing an increase, or they had not revised it yet. So you can see that the revenue distribution here is really uneven. A few states expecting small losses and a few states expecting, losses of up to 20% or more in their general fund revenues. This doesn't include, the surpluses that states had been expecting for fiscal year 2020, and it doesn't include, other state funds, but I think it shows you what states were expecting as they headed into the new fiscal year. And in a few minutes, we'll kind of talk about how this picture has changed. In another survey, which we don't have 50 states back yet, but another survey of fiscal offices, we asked for tax collection projections for fiscal year 2021. And personal income and sales tax collections make up the largest share of tax collections in most states. And as we've already discussed, those have been significantly impacted from the pandemic. And preliminary data from our survey shows that on average, states anticipate personal income tax collections to be about 7.2% less in fiscal year 2021 than in fiscal year 2020, and sales tax collections to be about 6.4% less. And these are pretty significant declines, especially when you consider that last year, states were projecting growth in personal income of about 3.6% and about 4.7% for sales. So we saw some pretty steep and quick declines, and states were kind of anticipating that trend to continue. So, that's kind of was the picture in July and August as states were trying to get a handle and guess what their revenues were going to be for the remainder of the fiscal year. But as I'm sure many of you have been seeing, headlines in your local papers that revenues are coming in better than expected. So I just kind of want to spend a little time talking about what that might mean for states. So there are some states where the data is looking much better than experts expected at the start of the pandemic. In Idaho, revenues are 9.3% above their forecasted levels. They're beating pre-pandemic forecasts, and the state is anticipating a significant surplus. In Kansas, tax collections in October were 7.9% above collections in October of last year, and the state is projecting that the budget shortfalls they had predicted for the next fiscal years will be narrowed significantly. South Dakota benefited from a strong domestic tourism scene this summer, and sales tax receipts are up 8.3% from last year. And Oregon revised their forecast by a staggering $2 billion recently. So a handful of states seeing, some great numbers, better than expected pre-pandemic. But I think what we're mostly seeing are more collections kind of like this, where we're seeing, revenues come in better than expected, but not enough to prevent significant shortfalls. Connecticut has narrowed and shrunk their deficit from $2.1 billion to $900 million. Florida collections in September were above expectations, but down 6.8% from previous years. And Wyoming's budget deficit was projected originally at $1.5 billion and is now at $250 million. And officials expect, though, that they'll still need about 300 to 500 million in new revenues. So in most states, while revenues are better than kind of the dire predictions everyone made at the start of the pandemic, they're better, but that doesn't mean they're good. And states are definitely still struggling. I think we'll see many states need to make budget cuts or raise revenues to kind of shore up their budgets in the next legislative session. And even officials in states where, revenues are much better than they anticipated, everyone's urging a lot of caution around these numbers and whether this trend can continue. And one of the main reasons is that all of these figures reflect a period when the federal government pumped trillions of dollars into the economy in a variety of different ways. Those funds really helped keep people employed, and it seems like people, really did go spend those stimulus checks and continue to kind of spend on online goods and different goods. So it's clear that federal aid helps soften the blow for states, at least in the short term, but those funds and programs have largely run out. So it's unclear, what collections are going to look like in the next few months for states. And I think, these numbers also show that there was pent-up demand this summer as folks were allowed back into restaurants and retail shops. And as states maybe have to roll back some of those openings, that could also affect these tax collections. So, there's some good news in the short term, but a lot of uncertainty whether these can continue. So the revenue piece is, of course, only one side of the picture. We know that during times of economic downturn, demand for social service programs increases. And so we really see state budgets kind of get squeezed at both ends. Eligibility for Medicaid tends to increase. People tend to apply for Medicaid more often during times of economic downturn. And we're still seeing a lot of unemployed people applying for unemployment benefits. Currently, there are 15 states that are using coronavirus relief funds from the CARES Act for their unemployment trust funds, and 18 states are already borrowing from the federal government to shore up their unemployment trust funds. So I think, especially without further federal aid, we'll see, especially those unemployment trust funds, continue to squeeze state budgets. So despite those kind of better than expected revenue reports, most states are still facing a budget shortfall for the current year and into the next. So far, the way we've seen states start to close those shortfalls is similar to the Great Recession, and have really been kind of led by the executive branch. We've seen a lot of spending freezes for agencies, furloughs and pay cuts for state employees, and then some kind of across the board budget cuts we've seen as well. The other way states can close budget shortfalls is through tax increases, which we haven't seen a lot of yet, but there have been a few, and Jackson's going to talk more about that in a few minutes. We have also started to see states tap into their rainy day funds, which I'll talk more about in just a second. Governors are starting to unveil their proposed budgets ahead of the next legislative session, so I think we'll get a better sense of where more targeted cuts might be taking place soon. So I want to talk a little bit about rainy day funds as a way to kind of shore up state budget shortfalls. And at NCSL, rather than looking strictly at rainy day funds, we typically look at a state's year-end balance, which is a combination of reserve funds and a state's closing balance. And this is data, again, from a survey of legislative fiscal offices. And you can see that states had really built up reserve funds after the Great Recession. Reserve balances were very, very healthy. States they learned their lesson from the Great Recession and were, I think, very prepared this time around. And from our preliminary data, you can see that states didn't really have to tap their rainy day funds much to close shortfalls for fiscal year 2020. The pandemic hit kind of at the end of the fiscal year for most states, so a lot of states had already collected some higher than expected taxes for fiscal year 2020 when it hit. So they were largely able to kind of muddle through with those spending freezes and other methods that I mentioned. But the story for fiscal year 2021 looks a little different. I think we'll see states tap those rainy day funds a lot more. They were projected back in July and August to be about 6.7% as a percentage of state spending at the end of fiscal year 2021. So I think we're starting to see states tap those funds more and more to cushion the blow. Just quickly, we've talked about how the CARES Act and the federal stimulus has helped shore up some state shortfalls. The CARES Act provided $150 billion to state, local, and tribal governments, but obviously it came with a couple conditions. The funds must be spent by December 30th, which is coming up quickly, and the money cannot be used for these revenue losses that we've discussed. But they have helped states, with some of the costs related to the pandemic that we have seen. And at this point, most states have allocated all of their coronavirus relief funds. Most states shared those funds with local governments that didn't qualify for direct payments. A lot of health and human service programs on the front lines of the crisis received significant support. Remote learning access and technology has been a big way that states have spent those funds. And a number of states have created grant and loan programs for small businesses using coronavirus relief funds. And as I mentioned before, they've used them in quite a few states to shore up those unemployment trust funds. So, I think by this point we all hoped we would have a better handle on where state revenues are, have a lot more answers, but I think, unfortunately, I always feel like a broken record that there's still a lot of questions and uncertainty out there. A lot of challenges still remain for revenue estimators who are trying to get a handle on, how much states are going to have to spend for the remainder of the current fiscal year and the upcoming fiscal year. As Erlinda kind of mentioned, I think the biggest question mark right now is whether Congress will pass an additional stimulus package, and if they do, what, if anything, it will include for state and local governments. Again, with the virus kind of surging again across the U.S., we might see more rollbacks and openings, which will affect state revenues. And there's still some questions about the type of economic recovery we'll see. And obviously, we've all seen the great news about a vaccine, but there are questions about how quickly we can roll that out and how quickly people can get back out there spending money and living normal lives. So a lot of challenges and potentially difficult decisions, I think, could be facing state legislatures in the upcoming session. And with that, I will turn it over to Jackson, who will kind of give us an overview of what we might see on the tax front and kind of an overview of some of the ballot measures that were on some of the tax and budget ballot measures that were on ballots this year.
Great. Well, thank you, Erica, and hello to everyone listening in. I'm going to delve into state tax actions in 2020, as Erica mentioned, and highlight some prominent trends that appear likely to grow as states work their way through fiscal year 2021 and beyond. We send out surveys to legislative fiscal offices across the country for our annual State Tax Actions Report that tracks all revenue changes made over the course of the previous calendar year. We're still putting that together, but we have received responses from the majority of states and have some information to share with you. Before I get into that, I just want to provide a quick bit of background on how the average state funds its operations. This chart shows state tax collection by source for the average state. Personal income tax, generally the most important revenue source for states at 38% of all collections, followed closely by the sales tax at around 31%. Obviously, this can vary quite a bit by state, as 9 states don't have a broad-based income tax and 5 do not impose a sales tax. The selective sales tax category is 16% of collections. That's your excise tax category, things like alcohol taxes, motor fuel, tobacco. Corporate income tax is about 5% of collections, and the other tax category includes sources like severance taxes or real estate transfer taxes, that 8.6% slice. Property taxes are generally a local revenue tool, but a handful of states do levy narrow taxes on things like utilities. And then not pictured here are things like federal transfers, which account for roughly 1/3 of all state revenues. So when the coronavirus pandemic hit, it interrupted state legislative sessions across the country, and a lot of issues, including tax, were placed on the back burner since the economic landscape had undergone such a dramatic shift. As Erica mentioned, states largely pushed through fiscal year 2020 by drawing on reserves, freezing or cutting spending and borrowing. revenue actions were relatively scarce. Several states reported that major tax initiatives were either interrupted or just fizzled out once the pandemic started to spread. And many states have reported few or no substantial tax actions. This graphic here on the page shows net tax changes through 2019. You can see that in years leading up to the pandemic, net changes grew by about 1% or less over the previous years. Based on the responses we've received so far, 2020 won't have a substantial positive or negative net tax change either. But I think it's safe to say that fiscal year 2021 will be busier, especially if no additional federal aid materializes. But that's not to say that nothing significant occurred in 2020, and here are some of the main trends that stand out from the preliminary responses we've received. Tax filing extensions were big. In response to the coronavirus, the federal government extended filing and payment deadlines for personal income taxes from April 15th to July 15th. And this gave a relief to a minority of taxpayers by allowing those who owed on their returns and hadn't yet scheduled a payment with their banks to hold onto their cash for a little bit longer. It also gave businesses and tax preparation services time to adapt to the logistical challenges stemming from the closing of physical workspaces across the country. For a number of good tax administration and compliance reasons, states were essentially obligated to do the same, and all of the states extended filing deadlines for personal income taxes, largely mirroring the federal deadline. And some provided extensions for other types of taxes as well. As Eric mentioned, in general, these weren't projected to have a fiscal impact, but at least 19 states, the extension pushed the receipt of revenue from fiscal year 2020 to fiscal year 2021, which presented some notable budgeting challenges. Federal CARES Act that passed back in April included a number of changes to the tax code to provide relief to businesses. Among other provisions, it expanded net operating loss allowances, it increased deduction for business interest expenses. For a number of good reasons, states with income taxes tie their tax codes to the federal code, so when changes are made at the federal level, it can impact state revenues. About half the states automatically conform to the federal code and have to take legislative action only if they don't want to adopt changes in the federal code, and the others conform only up to a certain date and have to take action if they want to adopt new changes. At least 14 states in DC automatically conformed to CARES Act measures. Several other states, for example, Colorado, Georgia, New York, North Carolina, decided they could not afford certain provisions and partially decoupled via legislation. And then leading up to the pandemic, the most significant tax trend was the implementation of laws to require internet retailers to collect sales and use taxes. All of the states that have sales taxes except Florida have passed laws to do so. All of the sales tax states except Florida, Missouri, and Kansas have passed laws requiring marketplace facilitators or entities that facilitate sales for third-party sellers, the Amazons or eBays of the world, to collect sales taxes on those third-party sales as well. Most of this had been accomplished before 2020, but there were a few additional marketplace facilitator laws enacted in states like Georgia, in Tennessee, and now that these laws are in place, a growing number of states are looking to require marketplace facilitators to collect other kinds of taxes that are applied on certain transactions. And this slide here shows some examples of what was enacted this year. Then excise taxes was a popular tax category this year. A number of states looked to raise revenue either by raising motor fuel tax rates. 6 states increased taxes on tobacco products or implemented new taxes on electronic cigarettes. Several states provided for the expansion of gambling operations. A couple states legalized sports betting as well. And then these are some not trending but noteworthy tax actions that had pretty significant revenue consequences in these states. California increased business taxes by suspending net operating loss deductions for taxpayers with net incomes over $1 million and limited the use of most business tax credits to a total of $5 million per year. And that was expected to save the state about $4.4 billion in fiscal year 2021. Nebraska enacted a big tax package that provided $125 million in income tax credits that were intended to reduce property tax payments. It also created a new business tax incentive program based on the number of employees and level of capital investment a business has in the state, which was projected to decrease general fund revenue by $135 million in fiscal year 2022. North Carolina and Tennessee both raised somewhat significant amount of revenue through healthcare-related taxes. We also saw the expiration of the Internet Tax Freedom Act's grandfather clause. Congress had prohibited the states from taxing Internet access as part of the Internet Tax Freedom Act in 1998, but that law included a clause to allow a handful of states with existing taxes on Internet access to keep them in place temporarily. That expiration date for those taxes was pushed back multiple times, but finally arrived on June 30th of this year. The 6 states still levying this tax were anticipating that expiration, but it was generating hundreds of millions of dollars in some cases, so not ideal to lose out on that money in the middle of an unexpected fiscal downturn. And then we had a couple of income tax related measures. Wisconsin had enacted a marketplace facilitator law in 2019 and had also priorly enacted a measure that required revenue from out-of-state sellers be directed towards income tax reductions. So the state saw an automatic cut in income tax rates this year that were estimated to reduce revenues by $120 million in fiscal year 2021. Using sales tax expansion to lower income tax rates has been a trend in recent years, but that particular mechanism is unique. And then New Jersey passed a measure recently that broadened the top income tax bracket to include all incomes over $1 million. The top rate of 10.75% had only been applied to taxable income exceeding $5 million per year, while income between $1 and $5 million was taxed at 8.97%. So that tax increase on higher earners was estimated to bring in up to $450 million per year in the first year. So those are the big legislative enactments, but we recently saw quite a few more. You all might have heard about the elections that were held last week. There were at least 30 tax-related ballot measures in 16 states that were voted on, and several significant ones passed. For states that might be looking to raise revenue in a politically palatable manner in 2021, the results could be of interest. I'll run through some of the most important ones here. Colorado and California voters took the side of businesses on a couple of property tax-related measures. California voters rejected a major proposal that would have repealed an existing property tax assessment limit that would have raised an estimated $8 to $12 billion by increasing taxes on certain commercial and industrial property. Colorado voters repealed a property tax limitation known as the Gallagher Amendment, which had lowered residential property tax assessments and shifted more of the property tax burden onto business property. It wasn't totally a pro-business measure. The result also prevented revenue losses of roughly $500 million from anticipated residential property tax assessment reductions. We also saw 3 big income tax measures. Illinois voters rejected a repeal of their flat tax and an implementation of a graduated rate structure that would have raised $3.6 billion. Arizona voters approved a 3.5% tax surcharge on taxable income over $250,000 for single filers, so that increases the marginal rate in the state from 4.5% to 8%, pretty significant. The state Joint Legislative Budget Committee estimated that it would generate about $827 million in the first full year of implementation. And then Colorado voters approved a personal and corporate income tax rate cut. On the sales tax side of things, there's only one big measure. Arkansas voters extended a 0.5% sales tax increase that had been passed back in 2012 and had been used to finance transportation projects. And then Colorado enacted a paid family leave program that came with a 0.9% payroll premium, which is estimated to raise $1.3 billion by fiscal year 2024 for financing. And then the excise tax front proved very popular. 2 states had to vote on increasing tobacco taxes. 4 had to decide whether to legalize the sale and taxation of recreational marijuana, and 4 voted on measures to expand gambling. all of these measures passed, and it really wasn't close on any of them. So, based on these results, 2021 could be a big year for excise tax. And on that note, when it comes to anticipating revenue actions that states might take moving forward, it could be useful to look at what they were focusing on leading up to the pandemic, how they responded to the last economic downturn. We tracked how states closed budget gaps during the Great Recession, and we've already seen some parallels with the current downturn, as states did not immediately rush to raise revenue in either situation. During the Great Recession, spending cuts and rainy day funds tapping usually came first, and then tax increases followed in later years. The personal income tax was a go-to revenue-raising tool for many states back during the Great Recession, with several targeting higher earners who could presumably bear that burden with greater ease. Between fiscal years 2010 and 2012, at least 10 states increased personal income tax rates. 8 of them targeted those increases towards high-income earners. In many cases, these rate increases were temporary. At least 10 states proposed legislation to tax higher earners in 2020. New Jersey, as I mentioned, was the only state to pass it, along with Arizona's recent ballot measure. In 2019, we saw a handful of states lower income taxes, but obviously times were different. I don't know if it's particularly likely that states will look to income tax relief unless they can offset it with revenue increases elsewhere. Broadening the sales tax base was another strategy states pursued. At least 19 turned to the sales tax to plug budget gaps after the last recession. A few states raised rates, but most action involved broadening the base and eliminating exemptions. Only a handful of states currently tax services broadly, which has become a problem as consumers now spend more money on services than tangible goods, which was not the case when states first implemented their sales taxes. The political opposition to taxing services has typically been pretty strong in the past. Quite a few states have tried and failed to tax services broadly. Utah last year was the most recent example. But we have seen several states enact legislation to tax select services in recent years. That includes Connecticut, Kentucky, Iowa, North Carolina, and DC. We've also seen a push to apply the sales tax to things like digital products, streaming services, software as a service. All these things are now taxable in roughly half the states. In 2020, taxes on streaming services were proposed by 8 states, but only Rhode Island enacted the legislation. But if you consider the number of people who have been consuming more in-home entertainment since the pandemic began, it seems like an area that will continue to receive attention. We also saw 3 states in 2020 propose new measures that would impose taxes on digital advertising. These presumably were targeting big tech companies. Washington, D.C. also proposed a tax on physical and digital advertising. There was a lot of controversy around these measures, which some experts were speculating could be struck down for being discriminatory against electronic and interstate commerce. But Maryland's measures still passed the legislature, even though it was vetoed by the governor, and it's likely that some of these will be up for discussion again. So digital advertisement front is something to watch. And then during the Great Recession, a few states increased business tax rates, several broadened the tax base, and then a bit later in the recovery, states began seeking business tax relief or reform measures. There have been several noteworthy trends in state business taxation recently that, at least in my opinion, seem like it would make it more likely that states will turn to business taxes to raise revenue a bit more than they did during the Great Recession. Some of these topics are hard to discuss succinctly, and I'm pressed for time here, so happy to talk more at the end if anybody's curious, but state implications of the TCJA and the CARES Act are likely to continue to be scrutinized because conformity decisions are a method to raise additional state revenue. I saw Representative Almy mention that New Hampshire included PPP loans as taxable income in the corporate income tax base. That hasn't been discussed by many states, but I expect that will be something that other states look at as well. And then excise taxes, again, as we saw popular this year, they were popular during the Great Recession too. Between fiscal years 2010 and 2012, at least 8 states expanded gambling, 4 states increased rental car taxes, 5 increased gas taxes, and 25 raised taxes on alcohol or tobacco products. Again, in many cases, these taxes or surcharges were applied only temporarily. And we can see this, developing here in recent years. Changing public viewpoints in hopes of generating new revenue have resulted in many states legalizing and taxing marijuana and sports betting. Most up till now have resisted allowing lottery tickets to be purchased over the internet or allowing internet casino gaming, but experiences with very productive mobile sports betting revenues during the pandemic will likely lead to a surge in other forms of iGaming. Again, transportation-related revenues have been eroded with the rise of fuel-efficient hybrid and electric vehicles. And over the last 8 years or so, at least 31 states have enacted legislation to increase motor fuel taxes. So motor fuel rates look like a potential option. And then, quite a few states looking to how to appropriately tax and regulate e-cigarettes. And then states are also looking at new revenue sources, short-term rental companies like Airbnb, transportation network companies like Uber and Lyft, car sharing companies. These are all presenting new regulatory challenges for states, and they've had to determine whether to shoehorn these platforms into existing regulation and tax structures or develop new frameworks to accommodate them. And as I mentioned, marketplace facilitator laws are being extended to require these entities to collect other taxes and fees in addition to sales taxes. So that may continue as well. When it comes to managing shortfalls, revenue sources like gambling or marijuana not going to be enough to plug major budget gaps, most likely, but typically it's a lot easier to raise excise taxes than broad-based taxes. So something we frequently see as a first step. But when it comes to what states might implement going forward, as Erica said, so much is contingent on first of all whether states can get these conserving COVID numbers under control and how much worse this current wave gets. Obviously, another more closures will worsen current budget outlooks, and it'll also depend on how much additional aid states receive from the federal government, which they've long been pushing for but have not received. Many are expecting that there will be increased flexibility for CARES Act money, but many analysts are saying that hundreds of billions of dollars more will likely be necessary. Doesn't seem likely that anything will happen before January, as Linda was talking about, and who knows what exactly we can expect from a Biden presidency and split Congress. But more federal assistance would probably equate to fewer tax increases. So that's it for me, and happy to take questions. Thank you.
Okay, great. Thank you so much to Jackson, Erlinda, and Erica for your presentations. That's a lot of information to absorb. So we do have time for a few questions from the audience. I know some have come across. If anyone else has one, go ahead and type it into the audience chat box. And just a reminder that this webinar is being recorded and will be archived on the NCSL website. So let's see, questions. So this one showed up a couple times. So this is for Erlinda, and a question about whether or not you have any insights on whether the December 30th date will be extended regarding spending the coronavirus relief funds.
Yes. Okay. This is Erlinda. Thank you for the question. Yes, there have been serious discussions on both the Senate Republicans and House Democrats and the administration, initial salvo for extending that deadline. So I'm fairly confident that whatever is passed or is negotiated that comes out, if anything comes out during the lame duck session, that it will contain an extension of the deadline.
Okay. Thank you, Erlinda. So somebody. Oh, whoops, my thing's moving around here. So another question is, with so many workers working remotely because of COVID, have states taken steps to address the potential tax implications of increased telecommuting? And this one is for Jackson.
Right. Well, remote work is a particularly significant issue in places where urban areas are close to state borders. I think like the tri-state area is the shining example of this. People who are working from home in Connecticut for a New York-based employer, does New York get to tax the income they earn, or Connecticut? And then, that extends to the corporate income tax realm as well. From what I've seen, this has so far been handled largely via regulatory guidance, but it sounds like tax practitioners are saying that more is needed because there's a lot of uncertainty around nexus and withholding rules. But those conversations will probably get louder as 2021 moves forward.
Okay, thank you, Jackson. Let's see, here's another one. This one is for you as well. In many states, when employment trust funds fall below certain levels, there are automatic hikes on employer payroll taxes to sustain them. Are states taking any action on this front?
I am aware of a handful of states that have passed legislation to delay or suspend increases in employer taxes due to a decrease in the solvency of a state's UI trust fund. California, Delaware, Louisiana, and Mississippi, I think. Indiana enacted a measure to prevent unemployment insurance taxes from decreasing. And I think Idaho was on the verge of having to increase its UI taxes, but until the governor transferred $200 million in CARES Act money to keep it solvent. Erica mentioned, I've seen reports that at least 20 states are already borrowing from the federal government to sustain their UI funds, and that money will need to be paid back at some point. I think states will do what they can to avoid significant payroll tax hikes, but might be inevitable in some cases. But again, federal assistance would really help on that front.
Okay, great. Thank you. And this next question is sort of for probably Erica and Jackson, but they're asking for your insight into what we expect the number 1, 2, and 3 methods will be for addressing budget shortfalls. For example, will it be cutting first, broadening tax base, and 3, increasing taxes? So if you both want to comment on that.
Sure. I think one of the number 1 ways we'll see is states using those rainy day funds, and probably some mix of that with budget cuts, especially if the shortfall isn't large. I think it will definitely depend on the size of the shortfall and the makeup and kind of culture of the state, but that would be my first instinct. Jackson?
I would say, yeah, hard to say. I think excise taxes look popular for getting money around the margins, and base broadening rather than tax rate hikes. I think that's a harder lift. Yeah, hard to
okay, thanks.
But tune in to the webinar next week, because we will have a couple experts really look into their crystal balls for us on what's coming on the tax front.
That's right. And just as a reminder, yes, we do have the final webinar in our series is next Thursday at the same time on emerging tax issues. But so, okay, Jackson, here's sort of a related question, and this one is about decoupling. Do you anticipate any increase in state actions to change the state relationship to the federal tax code, so to decouple, to connect, disconnect, or strategically disconnect from specific provisions?
Yeah, I think there will be continued action in looking at CARES Act provisions and TCJA provisions, because as I mentioned, decisions to conform or not conform carry significant revenue consequences. So I do think that there will be more scrutiny of that state-federal tax relationship.
Okay, let's see. And it looks like we have about time for one more question. And then here's one. What role might business tax incentives play in state strategies to help their economies recover?
Well, that's an interesting one. I think it's a unique moment for tax credits. Leading up to the pandemic, there was a big push in states to put in measures that would provide better oversight and procedures to evaluate the effectiveness of tax credits. There has been a lot of research in recent years leading up to the pandemic showing that we're casting some doubt on the efficacy of tax credit programs as currently constructed. So there's been, a lot of attention devoted to the pitfalls, but at the same time, states are going to be pressed to try to help businesses recover. I mentioned California just enacted that $100 million hiring incentive for small businesses. And Nebraska recently approved a big hiring and investment tax credit. But either way, I think this could be an opportunity to reform incentives to make the availability of them more equitable. At the moment, they often go to out-of-state businesses, but public finance experts say they're more productive if they go to locally owned companies. Cash incentives make up more than 90% of all incentives, but research shows that customized job training services are more effective job creation tools. Targeting distressed communities increases multiplier effects, but those efforts are typically scarce. So, in the current environment, I'd say that it will depend on the state.
Okay, great, thank you. And one last question really quickly that just came in. Can you repeat once more the healthcare tax increase in Tennessee and North Carolina?
Yes, that North Carolina and Tennessee, and to be clear, that's North Carolina applied the state gross premiums tax to Medicaid capitation payments received by prepaid health plans, and Tennessee established an annual coverage assessment on hospital and extended its nursing home assessment, and those were estimated to bring in quite a bit of money.
Okay, so that is perfect timing because the clock just hit 1 o'clock, so that is our witching hour here. So I want to extend a final thank you to all of our presenters. We greatly appreciate the expertise that each of you brought to our audience today. And thank you for the attendees for participating. We welcome the opportunity to have you join us for these. And the recording and presentation slides will be available on our website within a few days. And again, last plug for our final fiscal webinar next Thursday on emerging state tax issues. So that brings us to the conclusion of this webinar. So thank you again, everyone. Okay.